This is China, the fourth largest country in the world by area, covering approximately 9.6 million square kilometers and sharing a border with 14 countries, the most of any country in the world. China is an economic powerhouse and the second largest economy in the world today. But despite what you see now, it wasn't always this way. It's a country whose economic journey has been nothing short of remarkable. In every corner of the media over the last few decades, we've heard story after story of China's meteoric growth, a true rags-to-riches tale. From mass poverty to an economic empire. And it's true. Since 1979, China's been among the world's fastest-growing economies, with its real annual GDP growth averaging an astounding 9.5% through 2018. The World Bank described it as the fastest sustained expansion by a major economy in history. And it's led China to being second only to the US in terms of economic power. Rags to riches indeed. Yet, despite such an incredible success, in recent years, alarm bells have started going off. Reports of a slowdown have become more widespread. In fact, some even suggest a looming economic crisis just over the horizon. All of this begs the question, is the Chinese economy really losing steam? And if it is, could China's economic bubble be about to burst? To understand what's going on, we have to first go back in time. How did a country of over 1 billion people go from one of the poorest nations in the world to one of the richest in just a matter of decades? What can the history of China's economic miracle tell us about its current crisis, and is it finally coming to an end? The story of China's modern economic miracle begins in 1949 when the Chinese Communist Party came to power. Under the rule of Mao Zedong, there was, at first, significant growth. Early land reforms were successful, and price stability was achieved. However, today, this era is better known for catastrophe than economic success. The Great Leap Forward, initiated in 1958, was meant to transform China from an agrarian economy into an industrialized nation. Instead, it led to one of the most catastrophic famines in human history. Years later, in 1966, Mao would also enact his Cultural Revolution, which only further destabilized the economy and society. Political purges, social chaos, and economic disruption defined this decade-long period. Still, important groundwork was laid during the Mao era. China's new industrial-based expanded educational system and improved infrastructure all helped set the stage for what was to come. In fact, China's gross domestic product grew an average of 7.4% annually from 1952 to 1978. And the World Bank's first report on China was fairly positive. Following Mao's death in 1976, Deng Xiaoping implemented what would become incredibly transformative economic reforms. Under Deng, China began to shift from a centrally planned to a more market-oriented economy. These reforms, particularly after opening to foreign trade and investments in 1979, catapulted China's economic growth, rectifying economic imbalances, boosting exports, and replacing collective farming, altogether revitalized the nation's productivity. The success of these reforms under Deng's leadership, emphasizing reform and opening, led to higher incomes, more consumer goods, and growth across various sectors. At the same time, the reopening of diplomatic ties with the United States in 1979 marked another significant shift, attracting foreign investment. The late 1970s through the 1990s marked an era of especially rapid growth, which only accelerated when China joined the World Trade Organization in 2001. This integration into the global market significantly reduced trade barriers, and so China's exports grew remarkably, from a modest $10 billion in 1978 to a staggering $4.3 trillion in 2022. As a result, over the years, China's economy grew to surpass some of the world's largest economies and markets, like the United Kingdom and Japan. The early 2000s saw the Chinese rocket past the GDP of the most developed nations, and by the late 2010s, it became clear that if it didn't slow down, China's economy would catch up to the US in a matter of years. Of course, China's economic reforms also had the effect of transforming the lives of hundreds of millions of its citizens. According to the World Bank, over 850 million people were lifted out of poverty. Hundreds of millions of those came in just the last decade or so. Altogether, it's easy to see why many have compared China's rapid economic rise to a miracle. Today, though, economists have begun pouring cold water all over these accomplishments, with some even calling it a mirage. But why? What's going on with China's economy today? And why are some pundits and economists claiming its economic miracle has finally run its course? Well, as it stands, the warning signs have been flashing for years now. In 2015, the first of these alarms started going off in Beijing. That year, China's economy grew by 6.9%, compared with 7.3% a year earlier, marking its slowest growth in a quarter of a century. At the time, the International Monetary Fund had expected China's economy to grow by 6.3%, whereas Beijing had set an official growth target of about 7%. Growth failed to hit both markets. After experiencing rapid growth for more than a decade, China's economy was beginning to slow down. Already, growth in the world's second largest economy had missed its official target of 7.5% back in 2014, the first time in 15 years it had failed to do so. The trend only continued, and in 2019, China's year-on-year GDP growth fell to its lowest point since 1992. For their part, China was maintaining publicly that the numbers were nothing to worry about. China's National Statistics Bureau blamed in part a complex environment, both domestically and abroad. It said the Chinese economy had performed within the reasonable range in the first half of 2019, but it was also facing new downward pressure. In reality, this was China's way of referring to the ongoing trade war that had begun with the United States under President Trump. In 2018, Trump had levied tariffs on $34 billion worth of Chinese goods, escalating a war of worlds between the world's two largest economies into a full-blown trade conflict. Of course, China retaliated with tariffs of its own, resulting in what Beijing called the biggest trade war in economic history. Where cracks had already been forming in the Chinese economy, Trump's trade war only magnified the issues. Immediately, outstanding corporate loans spiked, outward direct investment dropped considerably, and the value added by Chinese industrial enterprises began to slow. However, the trade war was just one part of the evolving picture of China's economy. By late 2019, the end of China's economic miracle was apparent. Since its recovery from the 2008 financial crisis, levels of investment, retail sales, and industrial production had all been growing less and less with each passing year. Growth rates of all three sectors faced historic lows. The decline of Chinese industry was particularly evident. China saw industrial output grow at its slowest pace since 2002 in August of 2019, marking only a 4.4% increase. Weeks later, China's Premier Li Keqiang admitted that it wouldn't be easy for the country to sustain growth rates of above 6%. It was really beginning to look like the combination of domestic issues and the US-led trade war were both putting a brake on China's rapid expansion. Exports were taking a major hit, with Chinese goods exports to the United States falling considerably further than those to Asia and the rest of the world. Then there came an outbreak of swine fever. China, the world's biggest producer of pork, struggled to control the disease as it swept across the country. Even after slaughtering more than 1 million pigs, supply shortages continued, placing an additional drag on the economy. Pork is one of China's main food staples and accounts for more than 60% of the country's meat consumption, but the fever sent pork prices soaring. By the time 2020 was rolling around, it was obvious to observers around the globe that Chinese economic growth was faltering. Forecasts continued to project a slowdown, and it was looking like deeper problems lay beneath those on the surface. However, nothing was guaranteed. There was still the possibility that the economic giant could turn things around, but then came COVID-19. COVID-19, first identified in Wuhan, China in late 2019, rapidly evolved into a global pandemic. China, being the first epicenter, faced the worst economic impact from the start, with strict lockdowns and travel restrictions leading to industrial shutdowns, disruptions in supply chains, and limits on international travel and transportation. And although China and the rest of the world have mostly emerged from the pandemic and the economic crisis it caused, it's still key to understanding the economic trouble China faces today. In response to the threat of COVID, China implemented some stringent control measures, one of the strictest quarantines worldwide. This included its zero-COVID approach, which severely limited movement, businesses, and so much of normal life. Finally, in November of 2022, China eased up, and by early 2023, the country began transitioning back into a sense of pre-pandemic normalcy. Whether or not the measures were successful for public health, what is clear is that the economic losses caused by both the pandemic and China's response were massive. Instead of a normal 6% growth, China's GDP grew only by 2.2% in 2020. In 2021, it did bounce back with an 8.4% increase, But in 2022 came another outbreak of COVID-19 cases, and the ensuing zero-COVID policy. Growth dropped into the 3% range. A large share of the hit to China's economy came in the form of changes in consumption. Before COVID, consumption annually contributed to about 60% of China's economic growth, but this dropped sharply to minus 6.8% in 2020. That means it was responsible for a net contraction in the economy. Though it rebounded in 2021, it fell again in 2022. Meanwhile, the impact on Chinese exports continued throughout the COVID years, but to less of a degree. Despite a slight decline on total imports and exports from 2019 to 2022, China's trade recovered in 2021 with a continuing trade surplus. However, due to the pandemic and Russia's invasion of Ukraine, prices for some goods in international markets increased dramatically. And so, it's likely that Chinese exports increased in revenue but not in quantity. Still, that represents a far more positive economic indicator than that of unemployment. The withdrawal of foreign companies and the closure of domestic enterprises during the pandemic significantly worsened unemployment in China, especially among the youth. National data showed an increase in urban unemployment from below 5% to around 6.2%, stabilizing at about 5.5% by the end of 2022. However, youth unemployment, those aged 16 to 24, has fared far worse, reaching an astonishing 20% in Chinese cities in 2022. When we turn to per capita disposable income and expenditure, the data paints an ever clearer picture of COVID's effect on the Chinese people and its economy. Massive dips in both 2020 and 2022 show the economic hardship taking its toll. Altogether, the global pandemic was responsible for a huge hit to China's economy, from declines in consumption and production to just about all economic activities. But as the world and China reopens, the economy has slowly recovered. Still, despite that, many warning signs are flashing red and the outlook is not good. So, where does that leave China's economy today? China's once thriving real estate market has come to a halt, the nation is experiencing deflation, and there's a noticeable decrease in foreign direct investments and exports. Not to mention, youth unemployment has hit a new peak. The bubble that is China's economy really does seem on the verge of popping. But how? The makings of a slowdown in the world's second biggest economy have been far from simple, and at its root, it's a problem deeper than just slowing growth. No, the problem is one that threatens to bring the whole economy down in collapse. Let's explore the economic model that lies behind both China's miraculous rise and potentially its impending downfall. The best way to think about the China model of economic development is to think of it as an investment-led model. First and foremost, this model focuses heavily on investment in areas like infrastructure and real estate. And although it's been the overwhelming force behind China's transformation into a global economic powerhouse, it's slowly unraveling before our eyes. But why? China's investment-led growth model traces back to the post-1978 era, following the economic reforms of Deng Xiaoping. You see, 40 years ago, China suffered from chronic underinvestment. Housing, infrastructure, education, and services were very poor, and so the focus became investment, not consumption. And still today, consumption in China lags far behind that of other developed nations, while investment is far higher and responsible for around 40% of GDP. Central to this economic model was a massive investment in infrastructure. China funneled enormous resources into building roads, bridges, high-speed rail networks, and urban centers. The infrastructural development was not just about connecting cities, but also about stimulating industrial growth and enhancing the nation's global competitiveness. Alongside infrastructure, real estate development was another pillar of China's borrow-to-build model. China witnessed a construction boom, with cities expanding both vertically and horizontally at an unprecedented pace. This boom was fueled by both public and private investments, transforming the urban landscape and contributing significantly to GDP growth. But now the sector is on shaky ground. We'll get into that shortly. So, as we can see, the defining characteristic of China's growth model is its exceptionally high rate of investment. For decades, China's investment rates have been upward of 40% of its GDP, peaking at an unbelievable 47% in 2011. Rates that are significantly higher than that of almost any other nation. This aggressive investment strategy was instrumental in sustaining high growth rates for decades. It's important to note that a considerable portion of the investments was directed by the state, either through state-owned enterprises or through local government financing vehicles, LGFVs. This state-led approach ensured that Chinese investments were aligned with the broader economic goals of the nation. such as urbanization and industrialization. At the same time, this meant the expansion of China's economy was being financed by debt, and the investment-led model became reliant on it. Both corporate entities and local governments heavily resorted to borrowing to fund their projects. Sure, such an approach allowed for rapid expansion, but it also led to a significant buildup of debt across all sectors, reaching 330% of GDP. However, in the end, the most direct outcome of the investment-led model was growth. We've already seen how China consistently notched record-high GDP growth rates, often in double digits, which was unprecedented for a country of its size. Investment was the cornerstone of it all, but now it may be coming back to bite them. Another direct result of China's grand economic strategy was its rapid urbanization, with millions of people moving from rural to urban areas, seeking better opportunities. This urbanization was coupled with industrialization, leading to the creation of numerous jobs and the development of a robust manufacturing sector. This is why, in modern times, China has been widely considered the world's factory. The investment-led growth model catapulted China to new heights, earning the strategy widespread support at home and abroad. It became the world's manufacturing hub, a significant player in global trade, and accumulated vast foreign exchange reserves. Its GDP skyrocketed past that of the most advanced economies in the world, and elevated it to the second largest economy internationally. By prioritizing infrastructure and real estate development, maintaining high investment rates, and utilizing a state-led investment mechanism, China achieved rapid growth and significant industrialization and urbanization. But as China is finding out today, that economic model can only take a country so far, and it looks like now many of the weaknesses of this plan are finally throwing the Chinese economy into something of a tailspin. It's better to understand why. Let's dive a little deeper into each aspect of China's economic model and its failings, starting with debt accumulation, a challenge that extends across various sectors of its economy. Frankly, the scale of China's debt is striking. Since the 2008 financial crisis, China's economy quadrupled in nominal terms, while overall debt expanded a whopping 9 times over. Within this, the corporate sector, comprising both state-owned and private enterprises, is partially burdened. China's corporate debt alone accounted for more than 160% of its GDP as recently as 2016, one of the highest ratios globally. Such a level of indebtedness is unprecedented for an emerging economy and signals potential financial vulnerabilities. But government debt is also accelerating. State-owned enterprises are particularly notable for their high rates of borrowing, as are local governments. Local governments, typically sustained by funding from Beijing and the profits from land sales, have long been encouraged to borrow money to fund regional development, and they're reaching a breaking point. 2/3 of local Chinese governments carry debt above a global benchmark widely considered to be a point of warning. This comes as a near default by Guizhou's second largest city, Zunyi, in December of 2022, fueled concerns of a systemic financial crisis and hopes for central government bailouts. Safe to say, the situation has become untenable and highly risky. With all of this also coinciding with China's present period of economic slowdown, the debt situation only gets more complicated. Companies and governments that depended on continued economic growth for debt servicing now face huge challenges as debt continues to increase relative to GDP. Already, rumblings of a potential debt servicing crisis are beginning to show for Chinese local government financing vehicles. These financial vehicles are created to fund such things as roads, airports, and power infrastructure, but that means they rarely generate enough returns to cover their obligations. In the first half of 2023, the number of LGFVs missing payments on short-term debt have gone through the roof, climbing from single digits to almost 50 over the last 2 years. This much is clear. To thread the needle, the provinces and cities whose borrowing drove the world's largest infrastructure boom will need to roll back their spending and restructure debt, all without drastically dragging down economic growth. If they fail, it could thrust the world's second biggest economy into a prolonged malaise. Aside from debt accumulation, much of the problem with China's economy today in fact stems from the inherent imbalance of its heavily entrenched investment-led model, something Xi Jinping is hoping to begin to fix, but that will come at a cost. Last year, the Chinese government announced an ambitious 12-year plan that involves expanding household consumption to drive the economy, shifting away from investment over the long term. However, already critics say it's doomed to fail. A critical challenge in such a transition is the persistently low level of household consumption in China, which remains below global averages. Despite rapid economic growth, consumer spending hasn't kept pace. Retail sales and demand continue to grow at a snail's pace in China, when they're not flatlining altogether. This low consumption limits the domestic market's potential, making it challenging to stimulate economic growth through consumer demand. And even when Chinese households are increasing their spending, it's not all it seems to be. In recent years, household debt in China has rapidly spiked, reaching the levels of countries like Japan in just about a decade. Although it still lags the likes of South Korea or the US, it's still a cause for concern. This spike is also coming at a time where the average Chinese citizen has less and less disposable income to go around. While the median consumer has seen their disposable income increasing from year to year, that increase has plummeted from a 14% gain in 2013 to around 7% by late 2017. Altogether, these factors combine to create the lagging of consumer demand we're seeing today. Despite the will of the Chinese state, shifting towards a consumption-led economy would entail a real transfer of resources from the corporate sector and the governments to households. However, such a transfer poses its own set of challenges, as it would mean reducing resources available for state-run corporations and local governments. And the inevitable backlash from these powerful constituencies has likely already been enough to prevent Beijing from taking any real steps in the right direction. Finally, the last of the main stressors to the Chinese economy, and one which very well could bring about a massive crisis, is the property market. Easily the biggest drag on China's economy right now is the country's depressed real estate market, and already smaller scale crises are putting the rest of the economy on notice. Across China, new home prices are falling, with the month-over-month change largely showing red across the last year. This is not to mention developers also defaulting, all in all leading to a public that is rightfully so quite angry. Beijing has been trying to steady the sector by cutting interest rates and making sure builders can get access to financing, but nothing has been able to turn the tide just yet. Instead, the opposite is true, with multiple crises playing out over recent years. First, there was the Evergrande crisis. Evergrande was a Chinese real estate empire which amassed huge fortunes by thriving on soaring home prices during China's economic ascent. But that all came tumbling down in 2021. With billions in debt, unfinished homes, and unpaid suppliers, the developer came to the brink of collapse, shaking public confidence and stirring fears of contagion in China's financial system and the global economy. Now, the property crisis is only growing as another developer, Country Garden, appears to be heading for default after failing to make a payment on an offshore bond. The group has international debts worth around $11 billion and total liabilities of around $200 billion as of the end of June. With home sales drying up and thousands of stalled developments across China lacking the funds to continue building, the entire real estate market is in full-on crisis. At this point, more than half of China's former top 50 developers have gone into default, and Beijing has not been able to do much yet to soothe concerns, both at home and abroad. The broader fear is that a full-blown property crisis will have the effect of dragging the financial sector down with it. All in all, China's real estate crisis is one of its own making. Like we've seen, for years, the system ran on high investment instead of consumption, which was propped up and made possible by high growth rates. With the economy slumping and the Chinese government cracking down on excessive borrowing, a cash crunch ensued. So, what comes now for the Chinese economy? As the country grapples with these challenges, the future of its economy is under intense scrutiny. Growth targets for 2023 and 2024 have been downgraded, with GDP now projected to rise only about 5% and 4.5%. While China does seem to be on target for 2023, missing this reduced target would be a significant psychological and financial blow, signaling much deeper issues to come. The cut in growth forecasts is not merely symbolic, it represents mounting pressure and worry. Economists are not the only ones to worry either. Due to low consumer confidence, China is undergoing stark deflationary pressure, with prices sent tumbling. Chinese citizens, it would seem, are choosing to save rather than spend amidst all this economic uncertainty. And who could blame them? With the recovery from COVID still not totally complete, memories of job losses, business closures, and the ongoing property crisis are all front of mind. For the average consumer, household savings surged by 17.84 trillion yuan, equal to $2.6 trillion in 2022, up 80% from 2021. This reluctance to spend only exacerbates the economy's slowdown, further slowing consumption in an economy trying harder than ever to rely on it. Moreover, the real estate sector, once the bedrock of China's economic ascent, is still a source of serious instability. The debt crisis within major property developers suggests a systemic risk to the entire economy, reminiscent of Japan's asset bubble burst in the early 1990s. The Chinese government's regulatory tightening on the real estate market, while necessary to curb excessive borrowing, has only further dampened the sector's prospects. All things considered, the Chinese economy is facing what some analysts suggest could be a period of Japan-style stagnation. This scenario, what was known as the lost decade for Japan, saw its economy stall for years following a similar asset bubble burst. Years of economic malice and uncertainty followed before Japan could get back on track. Is China in for the same fate? The risks for China are there. Today, Beijing is confronting slowing growth, falling prices, and rising youth unemployment, with high levels of corporate debt, a cooling property market, and declining consumer confidence. From Tokyo, this all looks familiar, and in fact, China's economy is far more imbalanced than Japan ever was during its lost decade. China's debt also exceeds that of Japan's at the peak of its own bubble. The real estate frenzy in Japan was unimaginable. Yet, China's real estate bubble seems to have outdone it, with its residential construction reaching 20% of GDP, a figure triple that of Japan's at its height in 1990. Moreover, China's private sector debt has soared to 227% of GDP, exceeding Japan's peak by 13 percentage points. This is particularly concerning, given that China's GDP per capita is only half of what Japan's was in 1990. And like Japan, it's now facing a declining workforce as its population ages. As things stand, a declining population is only set to slow the growth of the economy even more. Current data indicates a sharp decline in fertility rates, from an average of 6 children per woman in the 1950s and 1960s to just 1.2 today. The overall population is forecast to shrink by 113 million between 2020 and 2050, while the number of people over 65 will rise and those below 20 will shrink. As a result, those over 65 will jump from 13% to 30% of the population. What does this mean for China's economy and its ability to navigate the current crisis? In short, it won't be good. The dependency ratio measures the amount of those under 19 and over 65 as a percentage of the working age population. Essentially, what percentage of the population is dependent on the other. For China, this ratio is rising and it's projected to continue climbing, with peak levels in 2050. Although China still has options at its disposal, like raising its labor productivity for example, which it has been achieving in years past, this demographic collapse spells another element of danger for the Chinese economy, an economy which is already basically on the brink. It should be clear by now that China stands on a precipice, its economy a massive bubble that is just about ready to burst, and that spells trouble for the broader global economy. One concern is what might happen if China tried to export its way to growth like it did in the 1990s and 2000s. Already, many advanced economies are struggling with economic recovery, and such an increase in the competitiveness of Chinese exports would be problematic. Additionally, the world economy is likely to depend primarily on emerging economies, especially China and India, to continue growing in 2023 and 2024. The European Union and the US are currently digging their way out of their own economic struggles as a result of COVID-19 and ongoing inflation. If China were to miss major growth targets, the entire global economy as a whole would also slow quite a bit. As the world's manufacturing hub and a major consumer market, a Chinese downturn would also disrupt international supply chains and reduce global consumer spending. Most at risk would be the developing world, like Latin America, which depends heavily on commodity exports and would be among the region most harmed by a prolonged slowdown in China's economy. The repercussions would also ripple through global financial markets. Investor confidence could wane, causing volatility and a sell-off in equities and bonds, affecting investments and savings on a worldwide scale. A devalued Chinese yuan might spark a currency war, disrupting international trade. No matter the exact trajectory, it's certain that an economic crisis in China would reverberate across the globe. With all that being said, there's still so many questions left to be answered as China's economic recovery hangs in the balance. Will China's policy measures be sufficient to stabilize the real estate market? Can consumer confidence be restored to drive the shift towards a consumption-led economy? And how can China address the demographic challenges of an aging population and shrinking workforce? There's a possibility that China's economy could recover. In such a scenario, China might succeed in restructuring its economy towards increased consumer spending and innovation, leading to a balanced and sustainable growth. However, that will all hinge on the government's ability to implement the necessary reforms and address the economy's underlying structural issues, like the real estate bubble and high debt. Alternatively, China could end up down the path towards a period of stagnation, mirroring Japan's lost decade with its slow growth. This might indeed be the most likely course, resulting from the challenges in rebalancing the economy coupled with the demographic pressures of an aging population. Stagnation would lead to reduced Chinese demand for imports and a slowdown in global trade, affecting economies worldwide that are dependent on China as a major trade partner. And finally, there's the worst-case scenario of an outright economic collapse, the bubble bursting, and the consequences would be far-reaching and potentially catastrophic. A collapse could trigger to a global financial crisis, and the impact would extend beyond economics, potentially leading to major geopolitical shifts of historic proportions. All in all, the path China's economy takes is still uncertain. It has the chance to reshape its own future, and the direction and effectiveness of China's policy responses in the coming years will be crucial in which of these scenarios unfold. But in the end, only time will tell. Thanks for watching.